Hello and welcome to Market Open Direct Connect, a webinar series for companies to tell their story, why it's compelling, and why it's an opportunity to invest. I'm your host, Stuart Walters, and we're joined here today by Scott Williamson, Managing Director of Blackstone Minerals, ASX code BSX. Scott will provide a company update and also participate in an extended Q&A with the attendees. Attendees will also have the opportunity to ask questions directly to Scott, and you can submit any questions via the Q&A tab at the bottom of your screen. It's now time to introduce our guest. Scott, welcome to Direct Connect, and over to you.
Yeah, thanks, Stuart, and great to be part of the Market Open team. And yeah, it's been a while since we did a good update, so really looking forward to getting into it. So today we're going to be talking a lot about our Manitoba consolidation strategy, and you can see here the Williamson project. So this is the previously operating Bucko mine in Manitoba, and so a lot of the focus will be on that today. So just in summary, we're looking to consolidate the world-class Thompson nickel belt. And the reason being is we want to feed the Tarkwa refinery for 40 years. And that's really the feedback we've been getting from the joint venture partners. They like the idea of the refinery in Vietnam. They like the mine in Vietnam, but they need the security supply over 40 years. And what we're going to do in Manitoba is driven by that understanding and that relationship we have with the downstream partners. So they require long-term nickel sulfide feed for their lithium-ion battery industry. And we're going to build this vertically integrated model across two jurisdictions, being Manitoba and Vietnam. And by doing that, we will produce some of the lowest cost nickel in the market, and it will be competitive with Indonesia. And most importantly, it will have that low carbon green nickel credentials. So this is a partner-supported, counter-cyclical M&A opportunities that we're looking at in Manitoba to take advantage of the current market conditions. So now is the time to be doing the M&A and really setting up this business for the next 10, 20, 30, 40 years. And that's really the opportunity that we've got in the Manitoba region. So you can see here, there's a number of projects, and we're at different stages of acquiring and partnering on these different projects. So we have the flagship will be the Williamson nickel project, the previously operated Bucko mine. Monago is another project that we've been focused on for many years. Lynn Lake, we have the ownership in Corazon, and then William Lake is also in the region. So if we just zoom into the region, so it's centrally located, and we've got significant rail infrastructure, and we can use that rail infrastructure to go across to Vancouver and then ship into the Vietnam refinery. So being located in the center, we can go west into the Asian markets. If we wanted to, we can go south into the North American markets as well. So we'll just jump into the Manitoba Hub. So you can see here, this is the previously operated nickel mine. This is the world-class Thompson nickel belt. It's been operating, the Thompson mine has been operating for over 50 years, currently operated by Vale. They've produced over 2.5 million tons of nickel. It's the 5th largest nickel belt in the world. And most importantly, it's got some of the best infrastructure we've seen. So you can see a rail line running straight through the project area that also connects in up to the Lynn Lake project. So you can see this is the Manitoba Hub, which we're looking to consolidate. I'll just jump in a bit closer to the Williamson project. So this is the project we put an option over late last year. We're currently working on that option and potentially looking to improve the terms given the depressed nickel market. So looking to improve the terms from the previous deal. So if we just jump into, this is the Bucko mine. So this was a previously operated nickel mine, operated between 2009 and 2012, and then shut down when the nickel prices were much lower than they are today. So we've got some great infrastructure here, but more importantly, we've got a large nickel sulfide opportunity. I might just jump over to Vietnam to sort of give everyone a refresh of what we've got over there. One of the things we like about Vietnam is the infrastructure we've got. So I'll just jump into the Haiphong port. So this is where the nickel will come. The nickel concentrate will come from Haiphong to Haiphong from the Manitoba region. You can see one of the most impressive and largest ports in the Southeast Asian region. And while we're here, I'll just jump in over to show you one of these hydro power plants. So our strategy is really built on our ability to deliver very low renewable power. So you can see this is the Hua Bin Hydro, 2 gigawatt. This is just a great example of some of the infrastructure that we've got in the Vietnam region, and the reason why we're looking to build the refinery in this location. And if we just zoom into the refinery, you can see here we've got 2 trains. So we're looking at staging the capex, and the idea is that we can reduce the upfront capital requirement, and that's important, obviously, in this current market. I'll just sort of fly through the refinery here. So you can see we'll bring in the nickel concentrate from Manitoba, but also from the Vietnam nickel mine. The final product will be this nickel cobalt manganese 811 product, and so that's still in very high demand from the lithium-ion battery industry and from our partners that we're talking to in South Japan. You can see here we've got byproducts in Epsom salts and sodium sulfate, and we've been able to find a strong market for those byproducts in Vietnam, and they will actually add to our revenue in our study work. And so if we look at the other half of the refinery, we can see here we also have the ability to extract copper. So you can see here the copper removal through the SXEW process. So we're using solvent extraction to remove copper, also the nickel, the cobalt, and so many different products and many different feedstock opportunities as well. So we have an intermediate product called mixed hydroxide precipitate, and that is also an opportunity because we can bring in different feedstocks from around the world. So if we jump back to Manitoba, the reason we particularly like Manitoba, not just because of the geology, but because we've got the lowest power cost we've seen anywhere in the world. So around 2 to 3 cents per kilowatt hour. You compare that to Australia, which would be 10 times. In Australia, looking at 20 to 30 cents per kilowatt hour. So this is the lowest power cost we've seen anywhere in the world. And most importantly, it's 100% renewable hydroelectric power. So as a bit of a summary, we're looking to consolidate the Manitoba Hub. We're calling it the Manitoba Hub. And that really is flagship, I suppose, is that Woboden project. So you can see here, at Woboden, we're looking at 1.3 million tons of nickel. And so to put that in perspective, over in Vietnam, we've got 500,000 tons. And you can see the grade is even better as well. So at 0.55% nickel versus over in Vietnam around 0.37. So big, large-scale opportunities. We've got a number of other consolidation opportunities in the region. We have there's 600,000 tons of nickel at Monago. Lewin Metals also looking to develop a nickel sulfide opportunity in the region. That's pre-resource. And then we've obviously got the interest in Corazon with another 168,000 tons. So in this hub, we can see over 2 million tons of nickel. So that's 4 times the amount of nickel that we've got in Vietnam. And that's what's going to give us the security of supply for the next 40 years to feed into the nickel refinery. And most importantly, we're looking at bringing 80% of our nickel from Manitoba, and that will make us 100% IRA compliant for our partners. So a big focus of our downstream partners is the ability to be IRA compliant. And if we can bring a minimum of 80% from Canada, then we'll be 100% IRA compliant. So just zooming into the region again, so you can see here, as I said, we've got some strong infrastructure where the Norway House, Cree Nation, are looking to acquire the Monago project, and we're currently working on a potential partnership with that group. They are looking at an extension of the rail line down to the Monago project. So what we would do is we'll look to put a new large-scale processing facility centrally located within the region, and within this region we can see over 2 million tons of nickel. So that is the opportunity for our downstream partners to have security of supply for the next 40 years. So what we're seeing here is some very large scale bulk opportunities, bulk open pit and bulk underground mining, very low strip ratios. These ore bodies have only been drilled to about 300 to 600 meters. The Thompson nickel mine currently are operating at 1.5 kilometers of depth after 50 years of operation. So this is a long-term opportunity. These ore bodies will deliver for multiple decades. They also have byproducts of copper and the platinum group metals as well. And we have the ability to deal with all those byproducts in our downstream refinery in Vietnam. So to put this in perspective, there are a number of large opportunities in Canada, and they are lower grade. So you can see a number of these lower grade opportunities in Canada are being supported by downstream partners from South Korea and Japan. We see a much better opportunity because our capex will be much lower. So these large ore bodies need billions of dollars of capital. We're looking at much lower capital hurdle, and the reason is because we've got that higher grade. So we believe that where you want to be sitting is in this medium grade range, and our consolidated project still has the scale and the tons to be of interest to these downstream partners. But more importantly, it's got significantly higher grade, which allows us to reduce the capital hurdle. So we're talking a few $100 million versus multiple billions of dollars, some of our peers in Canada. And this is where it all comes back to. It's all about getting our operating costs to a point where we can compete with Indonesia. So we believe with integrating the Manitoba Hub into the Vietnam refinery, we can produce nickel for around $10,000 per ton. And then we will then upgrade into the NCM 811 PCAM product. And really that's been driven by these low power costs in Manitoba and also in Vietnam. The low labor cost base, obviously, and the tax incentives that we get in Vietnam. So the initial years of is 0% tax. The first 15 years is an average of around 4% corporate income tax. So you can see here, most importantly, we think that we can sit about $1,000 per ton below the Indonesian supply. And unfortunately, you can see here the Australian market is obviously just priced itself out of the market at the moment, and that's really driven by the labour and the power costs. So yeah, we're confident we can compete with Indonesia, but most importantly, we've got the strong ESG green credentials to go with it. So just in summary, before we jump into the Q&A, we are vertically integrated. We're mining and refining across 2 jurisdictions now, and this is a partner-supported strategy. So we're not doing this because Blackstone wants to do it. We're doing this because the partners are saying this is what you need to do, and what we need to do is lock up 40 years of nickel supply, and we think we can do that in the Manitoba Hub, and we have partners supporting that strategy. We will sit in the first quartile, so that's important to be able to compete with the Indonesian supply, but we'll be able to beat Indonesia on all fronts because of that low carbon footprint. So we are developing a global strategy that is partner-led and attractive to downstream strategic partners, and we believe well positioned for a near-term re-rate on the joint venture and M&A opportunities that we see in the Manitoba Hub. Thanks, Stuart.
Scott, fantastic presentation, extremely informative, and we will get into the Q&A here. There's an interesting article that's come out recently in mining.com about the nickel supply gut. It makes the point that potential Russian supply loss will have minimal impact on nickel stocks. What do you think?
Yeah, I tend to agree. Like, I think the Russian supply, if you take Russia into perspective now, it's not the major part of the market that it used to be. Indonesia is where it's at, and but I think what people need to realize is that Indonesia is not, or the Indonesian nickel market is not going as well as everyone might first thought. So the fact that they're bringing nickel now from the Philippines across to Indonesia, I think the pricing around, when the pricing sort of goes around $16,000 per ton, you can see pressure on the Indonesian supply. So what we're seeing is this beat up around Indonesian supply is probably overdone now. I think Russia plays a small role, but it's really about Indonesia now. So I think, yeah, it's definitely worth keeping an eye on Russia. But if you want to keep an eye on what's happening in the nickel market, keep an eye on what's happening in Indonesia. And what I'd say is it's nowhere near as going as well as they had hoped. And the ramp up and the investment into the region has significantly reduced at these lower nickel prices. Thank you.
Is there currently much of a discount in terms of spot or contracted pricing from non-IRA compliant nickel supply? Assuming China would be the main consumer of nickel, is there any expectation that they'll flex their market weight around to get a discounted pricing like they have with Russian oil?
I think the way we see it is that at the moment there's basically two markets being established, and there's the Chinese market and then there's the Western market. There may be slight differences in pricing, but it's about the same. And so I suppose what we're seeing is the Indonesian supply goes directly into China, and then the Western world, they really want IRA compliant nickel. Whether they're going to pay a premium or not, I think we'll see. But I think we don't need a premium for our economics, and so we're not pushing for a premium. But we are building our strategy around the ability to be IRA compliant, because that is a really important part of the way that the West is moving. So yeah, you might see the odd discount here and there on non-IRA compliant nickel, but for us, it's not really about a discount or a premium. Our economics are strong at spot prices. For example, today's prices. We believe a good incentive price is around $20,000 per ton US, and that's what we've used in all of our studies, and we continue to use that. We think that's about the right price to incentivize some increase in supply, but also it's the right price for Indonesia to make some money as well. As I said, once it drops down to $16,000 per ton, there's pressure on Indonesia, and that's why it bounces off that level. And we believe the right level is around $20,000 per ton.
Scott, is there a direct market for nickel in Vietnam itself, or is it just likely to be exported to whomever ultimately signs an offtake?
Yeah, so obviously we've still got VinFast in country, but what we're seeing is it's most likely going to head into Japan or Korea. We have worked with all different international downstream players, including the Chinese. But what we're seeing is it's probably heading into South Korea or Japan, and that's really driven by the interest that we're getting from those jurisdictions. Whether VinFast will play a role or not, we'll have to see. But they are competing with a bigger international interest. So yeah, we'll have to see how that plays out.
Do you anticipate continued expenditure in 25 or financial year 25 on the refining process? So it'll be eligible for a further R&D incentive payment next year also?
Yeah, so we are at the final stages of the DFS. So the spend on the refinery will be reduced, and so we're getting to the final part of that. So there will be a smaller rebate, probably similar to what we're getting this year. So but it is definitely reducing. But then also we're looking to the next stage, because there's the engineering and design aspects as well. So even though we have a DFS, there are other stages required to get the debt funding. So there will be continued focus on downstream, and the R&D will come from that. Yes.
Can you elaborate on the Offtake Partner and when it'll be announced?
Yeah, so we're at the final stages of that joint venture process. So we started the process early in the year, and we're now at the final stages. We're conducting site visits and all of that. And so we're hoping to be able to come to market as soon as possible with the, I suppose, joint venture partner. And I suppose the important thing here is not just about offtake, it's more about bringing a partner that will bring equity into the business. And so as people have probably noticed, there is a lot of debt around and government-backed debt for these critical minerals projects. but it's the equity component that is the difficult part. And that's where we need to attract a partner that's putting sweat equity in, and they're going to partner with us for multiple decades. So that's why these things take time, but we are at the final stages of that process.
Is there any way you can sell any product as a concentrate to get cash flow? And if so, would it be profitable in this current market?
Yeah, so that's a great question. Unfortunately, we can't do that in Vietnam because there is a tariff on concentrate, and that's why we haven't gone down that path in Vietnam. What we could do is that strategy is definitely an opportunity in the Manitoba Woboden project. So you can see here, there is an existing infrastructure. It is in very good condition. Because it is inside the shed, it is in very good condition, and we could turn this on very quickly. So there is an opportunity to produce concentrate from the Woboden project. And so that is one of our strategies that we are considering, is a low capex restart to get into cash flow, and then build a much larger opportunity as a phase 2. So we are looking at low capex starter options for the previously operated Bucko mine in Manitoba.
Is there a way to get something value added up and running in a staged approach so we can get cash flow earlier with a smaller capex?
Yeah, so that's effectively what we're looking at. So what we're looking at, the current concentrator at Bucko is around 365,000 tonnes per annum. We believe the previous owners have probably built it a little bit small, so we would upgrade it. So we believe probably go up to 1 million tonnes per annum, which is the current size of the crusher. So we wouldn't have to upgrade the crusher. We would have to upgrade the milling circuit. And so we're looking at a small upgrade and then a restart. And so the good thing about that, this mine is permitted. And what we would have to do is we would do a notice of alteration to the Manitoba government. We are looking to restart. We're looking at a small change to the concentrator, and then we'd be able to start pretty quickly, and fairly low capex as well. So yeah, this is a great opportunity given the depressed capital markets, and what we're seeing is there's a bit of interest there from the partners on this concept as well, because it allows us to establish our footprint in country, build strong relationships with the local community, the First Nations, and really just set ourselves up for a much larger play as a phase 2 approach.
Someone's noticed that staff has agreed to take 50% of the salary as equity. At what price per share is the equity converted at?
Yeah, so that was done at the start of the year, and we were hoping only to do it for 6 months. It's now extended for 12 months. I think the price was around 5 cents at the time, so it was based on the pricing at the time. And so at the moment, it would actually convert at a premium. So the executive team have already done that process. The board still has to do that, and we're looking at doing it at 5 cents. So at the moment, that would be a premium.
And the price has been worse in the past. Why is the Australian industry in such dire straits right now?
Well, I believe that the fundamental problem with the Australian nickel industry is the power costs, and that's why we're like Manitoba. So as I said, 2 to 3 cents per kilowatt hour versus Australia be between 20 and 30 cents. So that 10 times the power cost to operate in Australia, unless you're on the grid, and then you might be able to get it a little bit lower. But most of the mine sites are on diesel or gas power, and so it's not only dirty power, but it's very expensive power. Then you've got the labor costs, and the fact that the nickel industry is competing with the gold, iron ore industries. That's where the best labor goes, and that just ratchets up the cost of labor. And so you combine the cost of labor and the cost of power, and unfortunately the Australian industry has priced itself out. And I think over time that'll come back, and we will renew our grid, and over time we will be able to get our costs down. But at the moment, the cost of operating in Australia is just not competitive with Indonesia.
And do you need to announce a JV partnership before we can execute the Woboden option, or will our partners only come on board after we've locked it in?
It's a really good question. So I think that option deal, what I can say is that that option deal is potentially going to be part of the partnership. So what we're doing is we're working with the partners on the option deal together, and so they will coincide. I don't think at the moment, I would say, yeah, our preference is to do it at the same time, and so we can exercise that option deal, but I think given the current market, it will be a much stronger message if we can do that with the partnership established, or at least at a point where we've been able to announce who the partner is.
What are investors and customers looking for in nickel projects, and where do Blackstone's advantages lie?
Yeah, so we're our advantage is definitely around our green credentials, our low cost as well. So we're confident that we can compete with the lowest cost producers in the world. So, and I suppose what's interesting is that when we talk to downstream customers, there's three things that they look at. They look firstly at cost, secondly is IRA compliance, and thirdly is green credentials. And unfortunately, the green credentials are third priority. And that's unfortunate, but that is the way it is. So cost is most important. IRA compliant is second most important. And then I'd say equally as important, but in a priority list, the ESG unfortunately is the third priority. But just as important, but unfortunately, cost and IRA compliance are more of a focus at the moment.
Is it as black and white as Indonesia v Australia?
I think it's probably worse than that. It's China versus the rest. And Indonesia is effectively China, but you've got a number of other operators in Indonesia. So there is definitely what the benchmark team call a battery arms race. The future of Western car manufacturing is at risk, and so this is a war, and unfortunately the West is way behind, and so the problem with the West is we haven't established our supply chains. We don't have the security of supply set up, and that's what China has been doing for the last 10-20 years. So they're well ahead of us, and we're starting to see that. And unfortunately, the West is trying to counter it with tariffs, and that's not the right way to approach this. They need to come back to first principles and start from mining all the way through the supply chain and build strong, resilient supply chains. And unfortunately, we're a long way from that. So it is. I think it's more about China versus the rest.
Can the establishment of the green nickel contract through Metals Hub work, and where will we see the impact?
Yeah, I think from my discussions, I think we're still a long way off a green premium being paid in a spot market. I think over time we will get there, but I think we're still a long way from that. I think green premiums may be able to be included into offtake discussions and sort of, I suppose, in confidence. I think we might be able to push for green premiums, but I don't think they'll be public, and they won't be on a open market, I don't believe. So I think it's a great concept, and I think over time we will get there, but I think we're a long way from that at the moment.
Scott, how does Blackstone see LFP and NCM going forward, as LFP seems to be taking greater and greater market share?
Well, I think it depends on where your market is. So LFP definitely has greater market share in China. In the Western world, it's all NCM. And so the reason why is because in the Western world, it's all about range anxiety and premium performance of the vehicle. And the only way you're going to get the premium performance of the vehicle is through an NCM battery. So I think that it's a little bit misguided to think that LFP is going to take over. I think we're going to see maybe 50% LFP NCM ratio over time. But in the Western world, it's nowhere near that at the moment. So people, and particularly as we work towards better EV take up, it's all about range anxiety, and that's why the premium OEMs are focused on NCM as their dominant chemistry mix. So, and I think as we move towards solid state, it will change again. So nickel is here to stay, and we're confident of that because of the conversations we're having with the downstream players. So they wouldn't be talking to us if they thought LFP was going to take over.
We've got a couple more that have come in. Does the industry require further government support, and how will policy shifts elsewhere in the US and the EU affect the industry?
Yeah, it's a good one. So obviously there's a lot of support from the US, EU. Unfortunately, we're not seeing that in Australia yet. We are obviously in the debt market, and that's probably coming back to what I was saying before. There is a lot of support from the government-backed debt, and that's become the easy part of the funding stack. What we're not seeing, and what we're seeing is that it's difficult for juniors to attract equity. And so, but we are seeing some equity checks being written in the US. So do we need that? No, I don't think so. I think the market dynamics will sort itself out over time as the election clears. People get more clarity around the IRA. I think in the new year we will see a big push from downstream players into those equity checks. So yeah, I think we're very, very close. So it's I don't think it's required. I think the market should sort itself out. But unfortunately, we've had some of these government policies haven't been clear, and particularly if you've got a change of government in the US coming, or not, and that creates uncertainty as well. So once we see some stability in the US government and the IRA, I think we will see those bigger players come into the industry in a big way, and I don't think we need government support.
Scott, what does Nickel West closure do for the rest of the sector? Does it open up opportunities for you, or is that bad news?
I think it's a great opportunity, and what I believe is that asset will be owned by someone that is linked into the downstream business. And so, for example, South Korea, Japan, probably not China due to FIRB, but if we take South Korea or Japan, for example, they're not too worried that Nickel West is a high cost producer and it might potentially not make money. What they're worried about is security of supply. And so that they can take a hit at a Nickel West level, for example, and still make good money in their downstream businesses. And so for these groups in Korea and Japan, it's about security of supply. It's not about economics. And that's why I believe that over time, those jurisdictions will probably play a really important role for an asset like that. And I think that's a great opportunity for Australian junior and mid-cap players.
Scott, thank you. That's all that's come through today. There's some fantastic presentation earlier and some great questions and extremely well answered. So thank you for taking part in the Q&A. For more information about Blackstone Minerals, you can head to the company website, blackstoneminerals.com.au, for join up to their Investor Hub page or follow the company on social media channels. Scott, thanks for your time today. I know the nickel industry is going through a tough time, but keep up the great work and look forward to chatting again soon.
Thanks, Stuart.